What do you think, before she speaks, what do you think of where the European economy is and what it needs right now?
The picture is quite mixed. If you take a look at the PMIs, then the economy is somewhat weaker than expected. Labor market, however, still remains strong. If you take a look at inflation, headline inflation has been coming down, which is good, of course. But core inflation is still quite elevated without a very clear downward trend. So at the current moment, I would still be in no rush to say that we are done.
Well, not necessarily done, but do you pause?
I would say that pausing does not mean stopping and not ever raising again. We need to see the data. We need to see the new forecast, which we will have in September, and then we will decide. But I think it's very important to take into account this kind of last mile element. And currently, I still think that, of course, the risks are now really on both sides, doing too little or doing too much. But I would still err on the side of raising the rates, given the current standing, what we see about the economy, because we can always cut. If, however, we stop too early, then, of course, later on it may require much larger interventions.
Well, do you feel confident that if you raise rates, you're not then risking growth and risking recession? And I guess the parallel question to that is the difference with the ECB and the Fed is the Fed's got one country. You've got a whole bunch, 19 countries, which have different economic situations now.
Of course, but we still do have one single monetary policy. So we have to look at something which is kind of an average, weighted average. But we very clearly have gone a long way. And most of the rate increases by far have been done. And further rate increases from today's standpoint are still going to be, if they are going to be relatively small. And if there is going to be damage to the economy, of course, we will do very much data-dependent decisions. And if necessary, one can always retreat. Okay. But I would still think that stopping too early is a bigger problem rather than kind of being forced to cut sometimes if the economy really turns out to be somewhat weaker.
Do you think that there are still long lags, still effects from the policy tightening you've done that are yet to hit the economy?
Yes, it's still in the system, and that's one of the issues why it has to be data dependent. One has to take it step by step when we see how those lags work through the economy, and that's why I wouldn't rush anything. So let's look at the data, let's see what happens, and let's return inflation to the 2% target sooner than the end of the 25, which is currently the end of the forecast horizon.
Well, how long do you hold rates at their peak level, whether it's here or you raise it a little bit?
As long as necessary. The rates, in my view, are already in the restrictive territory. We may need to take a few more kind of decisions if necessary, but we just hold on to the rates when we see that inflation really comes back down to the 2%. And I would very much look forward to what happens with the core inflation. If the core inflation does not come down consistently, then of course there is a risk that headline pulls up back, and you don't want to have that.
Well, if you keep rates higher for longer, as inflation comes down, real rates rise. Yeah. Is that going to be an issue?
Of course it will affect the economy, and given that we will take step-by-step approach, given what the data says, I think we are well covered for that. But I think that one should not think of very sharp rate decreases when it happens in the future. I think that would be relatively cautious, step by step, at least for two elements. One is it's quite likely that neutral rates are higher than they used to be, at least in the medium term. And point two is we would need that policy space to counteract other negative shocks. So I would not see it necessary to give up the policy space that quickly. So the decreases most likely are going to be relatively slower than we saw kind of the rate rises in the last year.
What would you like to see to be looking at that kind of decision. Do you need to get really close to 2%, or do you need to be below 3 and sort of on a month-by-month basis making progress?
Of course, it's going to be very much the current data, but also the current outlook at the time. And I would see that we would really need to cut the rates when the inflation outlook starts to consistently undershoot our 2% target. If we converge to 2%, then why should we rush with the rate decreases?
Some members of the committee have suggested you're facing sort of a stagflation situation where inflation is coming down but higher than it should be, but growth has stalled. Do you see that as a danger?
I think you don't want to get stuck there. At least I wouldn't want to get stuck in a situation when rates are not high enough to push inflation down. So the policy choice is quite clear. Our mandate is 2% inflation, and if we are not at 2%, we would need to maintain stricter financial conditions than at the time.
Would you, since you did say that the neutral rate is probably higher, where do you see maybe rates settling out once this is behind us?
I wouldn't speculate about that at the moment.
Oh,
we'll
really?
see.
Come on, everybody would love it.
We'll see. We'll see when the time comes. I think step by step is an important approach here.
What is happening with the labor market in terms of wages? I know in Germany we've seen a lot of pattern bargaining that pushes wages up. Does that spread to other countries, and are you seeing wage growth that's still at an unsustainable level?
Wage growth is really strong. Of course, country depends, kind of differs from country to country. It depends on the situation. But overall, wage growth has been quite strong. So what we've seen inflation affecting wage growth. What we should be very careful about is that wage growth starts to affect inflation. So we should not allow for that. The labor market is still relatively strong, so that is one of the key reasons still to be quite concerned about the core inflation and the link from labor market to inflation. So that's why I said no need to rush with the monetary policy decisions saying that, well, we've done what was necessary. In my view, not yet.
Can't let you go without asking about the elephant on the continent, and that is the war that's underway. You're getting ready for another winter. Energy prices always a concern. What kind of effects is the war having right now, and are you worried that things will get worse economically because it continues maybe into the winter?
Links with Russia itself are very minute, if any. But of course, the largest exposure is with respect to the energy sector. But European economy has done quite well. We've stockpiled quite nicely. But of course, all those negative shocks are the risk elements. And that is one of the reasons also one has to be cautious. But I would be very happy perhaps to say that the worst is behind us and we've dealt with this much better than one would have expected a year ago.